Good morning, everybody. You're most welcome to this session, which is entitled So You Think You Know Everything About a Shareholders Agreement. This is indeed a very hot topic, and the request to deliver this came from the Entrepreneur Experience alumni groups. And I'm going to we'll talk about that in a moment, but just to let you know that we have over 300 people registered and joining us this morning from all over the world. And I would like to introduce you to my friend Pete Smith, Pete Smith is Broadlake, and he's also the captain of the Entrepreneur Experience. Pete.
Thanks, Eileen, and thanks for having me. And I think we have a wonderful lineup today around this topic of shareholder agreement. And just for a warm-up, I'd like to just bring the audience up to speed on a couple of other exciting developments, both at an entrepreneur experience level and also at a CorkBIC level. And the first one is that having had the 2021 entrepreneur experience as a kind of a virtual event and a super event that got a huge amount of people involved, and it was a huge success, we're pleased to announce that we're hoping, fingers crossed, that this year's event in October is going to actually be in person back in Ballymaloe, the home of the Entrepreneur Experience. So it's scheduled for the 15th and 16th of October. The applications are going to be open from June. We do ask a lot of the people on this call and people in the alumni to recommend companies that they think would be suitable for the Entrepreneur Experience. Because for the right types of company, it's just a wonderful experience. And now it's built up such an alumni that we're super excited about getting people back in the room. So that's the first thing. So do spread the word and do make sure that people get in the applications when the application window opens in June. The second one is to talk about that alumni. So the alumni now is over 250 people. And one of the things that we felt in the past about the Entrepreneur Experience is it's such a magical experience when you get to experience it in person. So you get to come for the 24 hours and you get 24 emerging entrepreneurs matched with 24 seasoned entrepreneurs. And it's that magic by them working together to help the emerging entrepreneurs. And out of that, not just the emerging entrepreneurs receive help and energy and ideas, but the seasoned entrepreneurs experience the exact same. So one of the things that we've been trying to do with the alumni is to bring them together. So this isn't an annual gathering. So we're bringing the people together more regularly to share ideas and insights and learnings, right? Part of that is through the events such as this that CorkBIC are organizing, and virtually it's been a huge success. But we're also on the side setting up these alumni groups. And we have about 50 of those 250 people that are involved in alumni groups. And they are small groups, 6 to 8 people. They come together maybe every 6 to 8 weeks for an hour and a half, and they just chat about what's going on in their businesses, right? Entrepreneurship, as we know, when you're at the top of an organization, it can be a lonely place, right? So to be able to have peers outside of your organization, it's a wonderful benefit to have, and to compare notes and ideas. Sometimes we generate the ideas from our own organization, but it's good to have ideas coming from outside the organization. So one of the things we're doing now that they're set up and running, and I've been in touch with a number of those groups in the last week, is to actually put a greater emphasis on that. So what we're doing, we're going to put a lot more focus in terms of getting the qualities of those meetings up and up and up, and also getting more people involved in the network. So that's something that's going to happen more and more. So for you out there on the screen, I would encourage people who are not involved in a group. I think it's a great idea. I'm involved in a couple of groups personally, and they benefit me hugely. So I would encourage you to get involved. So as the Entrepreneur Experience, that's the wonderful stuff's going on in the world of Entrepreneur Experience alumni, right? We're pleased on the Entrepreneur Experience side of things to have the people that have supported us for years in terms of partners back supporting us, right? And that's because it's been such a fruitful partnership, right? And that's the way we see it. We see it as a partnership. And they are Cork City Council, Cork County Council, Grant Thornton, AIB, and BDM Boylan. And without them, we couldn't put on all of this. So we do really, really appreciate it, right? Now moving on to today's topic, and I think today's topic is fascinating. Most people see shareholders agreements as fairly dull, boring documents that are prepared by lawyers as a must-have, as a kind of I need to have it, but I don't really want to have it, etc., etc. I think the conversation today is going to totally reposition that. I think they're very positive agreements that are made at the outset, where people can actually get to know each other in terms of what are the desires of shareholders, what are the desires of management, and what's the partnership going to look like And it's wonderful to have those conversations up front to make sure the alignment and the magic of that is there from day one. And as the businesses grow and develop, these agreements might evolve. And we have a wonderful team teed up today to have that conversation, right? So it's coming from all different corners. I'm going to hand you over first to Aidan O'Driscoll, right? So Aidan O'Driscoll is ideal to set the scene here today. So he's 25 years experience in this kind of early stage space. And what I would say about Aidan, the wonderful thing is he comes in it from an investment side of things. So he very successfully set up Iris back in 2012 as a kind of an angel network. Their focus is mainly on the technology and life science side of things, right? But they're also focused on not just investing in businesses, but trying to help those businesses, right? And they've invested 25 million to date. But not only that, they've then positioned those businesses to go out to the outside world and raise another 55 million, which is a credit to their success in terms of the operation they're running, right? They have super successful investee companies, Aventamed, Blue Drop, Medical, and Corey Valve, which are to name just a few. The wonderful thing I think about Aidan is that Aidan not just is an investor, but is also somebody who works actively with the companies on a consulting side of things. And that's not just in finance. So you'll find Aidan working with the businesses on strategy. You'll find him working with the business on marketing, on sales, et cetera, et cetera. So the easiest way is sometimes when you have a discussion and somebody's coming at it from one side of the fence, it can be kind of biased. The wonderful thing about Aidan is Aidan has the investment side and he also has the company side. So he sees when shareholder agreements sit in the middle, he's got a unique perspective because it's looking at it from both sides. So I know he's a wonderful presentation teed up. I know there's a wonderful panel here with lots of different complementary and interesting views on this topic. So I'd like to hand you over to Aidan, who's going to get the ball rolling on the topic.
Thank you, Pete. Good morning, everybody, and thanks for that, Pete. So basically what I want to cover here today are normally the issues that affect people when they sit down with their potential investors and the problems that they encounter and issues that they should be aware of. So first of all, we look at the instruments that companies use to invest. It can either be ordinary shares, which has been typically the way that companies have invested over the last number of years. Investors have seen that ordinary shares has been their preferred vehicle, but that is beginning to change. With the change in the law with regard to EIS, where people get their tax benefits, preference shares are now becoming more prevalent. And preference shares are not the same as ordinary shares. And investors normally look for a thing called liquidity preference. And that in its simplest form is if an investor invests 200,000 in a company sells for 1 million, then that investor will get his 200,000 first and the balance 800,000 will be distributed to the remaining shareholders. So it's something that people should be aware of. It's becoming more prevalent. And there are different forms of preference, liquidity preference. And there's one called a participating liquidation preference, which is called the double dip. And the double dip, in its simplest terms, going back to the previous example, is that they would get their 200,000 out first, then the balance of 800,000 is shared amongst all shareholders, including the investor again. So when you are offered preference shares, you should be well aware of the terms and the terminology being used so that you understand how it could affect you in the future, in any future sale. Some of these preference shares also have dividends attached to them, and these accrue and they add on at the end, so people should be aware of that. And also, the other form that's common is convertible loan notes that normally carry an interest rate, and which is typically around 8%. It accrues and it normally capitalizes at the end of the investment term. Crucially, convertible loan notes do not qualify investors for EIS relief. So the way I see it going forward is that preference shares will become more and more prevalent in the future. The next element is the board size and the composition of the board. Investors typically are minority shareholders. So as minority shareholders, they want to have a say in the running of the company. They don't want to be outvoted. So typically they request that there's an independent chairman person appointed. normally an independent non-exec who would have some industry experience. And they would normally look for a permanent seat on the board where they own more than 5% of the shares. And they would typically limit promoters to 2 directorships. Overall, they limit the size of the board to 5 to 6 people. So again, people should be aware, even though you may have the majority shareholding, you may not have the majority voting on a board. So people should be aware of that. Directors will require that they have directors and officers indemnity insurance. And typically, we look for monthly board meetings initially, and thereafter bi-monthly. The directors, this is their only contact in the day-to-day really running of the company. So it's very important from them that these boards are properly set up, that the documentation is forwarded before any board meeting, and that people take an active participation in the board and in the board meeting. And the board meetings typically would run for 3 to 4 hours. Another area which causes a lot of concern for individual promoters is this whole area of whereby warranties and undertakings are given. When an investor invests in the company, he wants to be assured that everything he has been told is factual, that nothing has been left out. So on those occasions, a disclosure letter is normally attached to the shareholders agreement. This disclosure letter covers every aspect of the company from contractual agreements, management accounts, your tax affairs, everything. Anything that is left out and that turns up afterwards can constitute a warranty claim. And these claims can be both joint and several. So if you have 2 promoters and 1 promoter can't make up the balance if there is a claim, then all of that, then if it is joint and several, goes under 1 individual. Everything you state in your business plan is what you state to the investors is the way forward. Any breach of that or any significant change will initiate a warranty claim. So again, it is important that in your initial relationship, that everything is disclosed. The liability in some cases is unlimited, but what we typically now see that is limited to about 2 times the promoter's salary. And these warranties stay in place for 2 years. And for tax, they stay in place for 5 years. Similarly, an investor wants to look after, what happens if somebody leaves, a key promoter? So normally there's restrictive covenants put in place that if you leave, that you cannot hire an individual, you cannot you cannot hire an individual that worked in your company. You cannot go back into the business that you've previously been in. And you cannot sell any of your shares or commit any of your shares to security without the written approval of the investor majority. And on top of that, because investors are the minority shareholders, there are restrictive transactions. They number about 30. They vary from capping what a salary level should be, the issuing of new shares, declaring dividends, appointing the auditors, getting rid of the auditors, all must get the written approval of the investor majority. So what happens in effect is, even though the investor is in the minority, by these restrictive covenants and transactions, they can control everything that you do. So it's important that you form the relationship with the investor, be aware of what you have to go back to them for approval, because that dictates how your relationship, how your work goes with them going forward. This is the most controversial of all the things that I've come across in the 25 shareholders agreements I've executed over the last number of years. Is a thing called reverse vesting. In simplistic terms, what it means is that a promoter, if he leaves, normally within a 4-year period, will have to give back their shares to the company. These would vest over a 4-year period. So, for example, if you leave after year 1, then 75% of the shares go back to the company. And at what value you get for those shares depends on whether you're a good leaver or if you're a bad leaver. If you're a good leaver, those shares normally would be at the last round valuation, or you can bring in an independent auditor to value them, or it, as in most cases, when this does happen, the board comes to a compromise and evaluation with the individual. If you're a bad leaver, and somebody always asks me, what is a bad leaver? Well, a bad leaver is everything a good leaver isn't. So your shares then are valued at nominal value. So basically, they are worthless. So again, this is a very punitive thing in a shareholders agreement. It is the thing that gets promoters ante up in a big way. And you should really understand the effects of it. Now, from an investor point of view, they have been sold their investment by the promoters. They are putting all their money on the promoter. So they don't want any promoter to leave. So this is handcuffs, if you want to use the word, to keep them in place during the critical period of an investment. Okay. On top of the fact that you now have new investors on board, they own probably between 20 and 30%. That's the normal percentage that they would take. Every board meeting in advance now requires that they get certain information rights. And typically, they're asked to put together a board pack, and that board pack covers everything really to do with the financial side of the company, on the operations side, research and development projects, a future forecast of what the cash requirements will be, any issues with employees, and how they're doing in accordance with the milestones that they've set in the business plan. And on top of that, annual audited accounts and annual budgets have to come before the board for approval. The second most controversial element of all of this is the down round protection. So people get very confused about this. So in this simplistic terms, if an investor invests at a certain valuation and subsequently the company decides to raise money at a lower valuation in the future, then the investor is compensated for the loss in perceived value between the original valuation and the lower valuation. That is called a full ratchet. And I'll give an example of this very shortly. The next one is one that is becoming more prevalent, is the weighted average. And the price is adjusted, taking various parameters into place, and it is not as punitive on the investor. Sorry, I beg your pardon, on the promoters. So if you look at this situation here, on this round, 5 million has been raised at $1 a share, and the investor has 33.3% of the company. If they go away and subsequently raise, as you'll see, another round at 4 million, and now that round is at 50 cents a share, then the original shareholder is compensated to reflect that he should now have gotten his original shares at 50 cents a share instead of $1 a share. So now he ends up with 10 million of these shares, and he ends up with 41.7% of the company. If you look here at the founder now has gone from 60% to 37.4%. So it is extremely punitive. And where the investor comes from is that in a lot of situations, companies and investors cannot agree on a valuation. And where an investor agrees to a valuation, then it turns out to be too high, then this is the consequences if you do a round in the future at a lower value. As you can see, it is quite punitive. The weighted average takes into account previous valuations, the new round, etc. And using the formula, which we will not, there's no point in getting into here today, you can see now that the founder is not as penalized, and he ends up with 46% as against when he had the previous round. So these are coming more common, but again, when you use the shareholders agreement, be aware of the consequences. The consequences of you coming into higher valuation, the consequences of you raising money in the future at a lower valuation. We will cover these issues in more detail in a minute when we're talking on the panel. So there are then a number of other issues which people should be aware of. You will often hear the words drag along and tag along. And drag along is a situation whereby there's an offer made for the company, and if more than 70%, which is the common, maybe even 60%, agree to sell their shares, the remaining 40%, 30% of shareholders are dragged along. They have no say in the matter. Again, if you end up being a minority shareholder, you should be aware of this. If you're diluted over a number of years, you become a minority shareholder. Then if you're below the 30% threshold, for example, then you're dragged along regardless of you agreeing to sell the company or not. Tag along is the opposite of that, whereby you as a promoter or other shareholders there's an offer made, and then the other shareholders can tag along and say, yeah, we must be given the same offer as well. Typically, in the shareholders agreement, there is an exit mechanism in place whereby, and it's normally 5 years, if the company has not realized its value or been sold, then the investors can appoint a professional advisor at the company's expense to come in and seek a buyer externally to the company. Legal costs, which a lot of people are not aware of, are covered by you, the company. So you pay the cost of both the investor and yourself. And a typical shareholders agreement today, these costs can go up to 20 to 30,000. Again, something that you have to build into your cash flow projections going forward. And investors also typically look to have 10% ESOP set aside, which will dilute you further and the investors for any new critical hires. We will cover these in the panel, and I'll hand over to Eileen now, and she'll look after this section of the show.
Thank you, Aidan. A lot to consider there. Let's go and very briefly, I'll introduce you to the other members of the panel. Teresa Chambers. Teresa, you're welcome. Teresa is a seasoned angel investor, many investments behind her, and she is also a member of the Bull Syndicate. Colin Manning is the commercial partner at BDM Boylan Solicitors. Ger O'Mahony is a serial entrepreneur. Ger has served on many boards, continues to serve on many boards, both as an executive and a non-executive director. And he has also played the role of chairman on many of those boards. So you're all very welcome. Just to say to people, if you would use the chat, that'd be great. And we'll try and pick up questions if we've got time, but at least we know what way you're thinking and what issues we need to address. I want to come back to you, Aidan, just on something you said early in your presentation, which was the trend towards investors liking preference shares these days. And maybe you could talk to us about some of the consequences of that.
Well, the main consequences of that is the preference shares rank higher than the ordinary shares. So in the event of any liquidation or future sale, the preference shareholders get paid first. So they're not treated the same as other ordinary shareholders. They also can have a coupon attached to it, which makes it more attractive. And so if a coupon of 8% is attached, then that coupon accumulates over time. So if you're at the end of a 5-year period, you're adding on 40% more. So people should be aware that the consequences of a preference share on the other ordinary shareholders, and also they have more rights, and typically with the advent of EIS, there come now a very attractive form of investment.
Okay. And just while we're there, I saw a question coming in, which is a question that I wanted to ask you as well. Is there a timeline for a down round protection to kick in?
In some instances, you can put a timeline in, which would typically be 2 to 3 years. In some cases, there's no time limit. That is a thing that should be negotiated.
Okay. And talking of negotiation, Colm, maybe you could share with us some of the things that you see coming in your door, because very often you're the first person somebody brings either their term sheet or their shareholders agreements to make some sense of it. So if you had some examples of how that works, maybe you could share those with us.
Sure thing, Eileen. Yeah, I suppose the issues I see in shareholders agreement really depend on what's prompted the parties to enter into it. And I like to put shareholders agreements into 2 kind of categories in that regard. The first is part of like a third-party investment, and Aidan's spoken to it there, a subscription of shares. And I suppose Aidan correctly pointed out all of the things that come up, and I suppose a well-drafted heads of terms will kind of deal with those things up front. But from my perspective, certainly the hoary old question, and the one that really lands as an issue for a founder or something to talk through with their investor, is of course the warranties. Of course, the lawyer is going to say that. And I say it lands when the shareholders agreement actually comes in from the investor, because oftentimes you see in a heads of terms, it's while you might have the liquidation preference and other restricted transactions and business plan provisions, the warranties, the investor protections tend to be a bit light in detail, something generic about standard investment warranties for an investment of this type. So when the investment agreement comes in, you oftentimes have a founder double taking at 15 pages worth of business warranties. Some of them, the founder is of the belief that they don't apply to them. So you can have, a founder or the company can kind of double take at, 15 pages of warranties dealing with IT, IP, finance, accounts, customers, suppliers, tax, employment. And, they're kind of saying to themselves, God, what is this? I'm a relatively small company. Most of this doesn't apply to me. And in that type of instance, it's well, on the assumption that the warranties aren't completely off the wall and there's some market standards, limitations of liability in there. I oftentimes take the opportunity to say to the founder there of the company that, well, look, use this warranty and more importantly, the disclosure exercise. Kind of flip it away from it being like a somewhat kind of negative and perhaps a little defensive kind of exercise into something a bit more positive, and particularly the disclosure exercise to really invite the investor into the business, to let them see all of the problems, the good, the bad, and the ugly that is in there. And I suppose that's I think Pete spoke to it at the start, that's that collaborative approach to it that is going to serve well in the long run. And like as part of that, I suppose an investor is going to understand, if they're sophisticated and know what they're doing, that no business is perfect. And the effect of a suite of warranties is to essentially say that the business is perfect, and that doesn't accord with reality. If you've got customers, you've got problems. If you've got suppliers, you've got problems. If you have employees, you've got problems. An investor will know this and will expect those problems to be put forward to them as part of the disclosure exercise. So inviting the investor in to do that, collaboratively doing it, to make sure that in 2 or 3 months time, that those kind of things don't jump up and bite anyone in the backside and cause any issues.
Mm.
That's what the investors certainly looking for. And I oftentimes describe the warranty, and particularly the disclosure process to a founder or a company, as their insurance policy to make sure that, look, put the investor on notice of absolutely everything in there. It's counterintuitive as part of the initial stage of the investment to start putting the problems out there, but that's what an investor is going to expect, and that's what they're going to see.
And what will be maybe one or two of the questions you will be asking the founder to make sure that you're getting the full story from them?
Yeah, absolutely.
There's always the danger that there's something they're not even admitting to themselves.
Absolutely. And look, when that investment agreement comes in and you're looking at the 15-page documents, I say to the investor, look, we're going to put aside 5-6 hours and we're going to go through each and every one of these line by line. It's tedious stuff. You will get very, very bored, but it's kind of going through it in detail is an important thing, because you know, unless you look at it in that detail, something might slip by. And the main thing that always triggers that kind of doubling of the effort to make sure nothing is missed and that things are disclosed is to make it clear that, look, the investor is going to look for these protections, and because of that, they're going to look for the company or the founder to stand over them from a warranty perspective. So you're on the hook personally, and particularly at early stage companies, getting that focus in terms of what's going on underneath the bonnet of the business can be a bit of a challenge, but it's just an exhaustive exercise that they have to go through.
Sure. Let me come to you, Teresa. I know that you're very strong on getting everything into the term sheet that might cause a problem before you get into doing the shareholders agreement. So would you tell us some of your experience there, and what are the key things that that you want to see and how you address them in the term sheet?
Sure, yeah, Eileen. Yes, well, the term sheet, basically it's the document before the shareholders agreement. Now, within the syndicates, we have a master template for the term sheet, and this is useful because really what that is doing is capturing all the items up front. And by putting all the items up front into the term sheet, it really means the founders and the investors get together and they can talk those through and really be clear about what is in there right from the beginning. And it kind of prevents, when you get to the next stage, the shareholder agreement stage, it prevents new things coming up at that stage. So this is done really during due diligence. So you're doing the due diligence of the company at the same time. So you're assessing the product, you're assessing the people and the founders themselves, and then the whole business. And during the same time, you're working through all of the terms. Aidan kind of went through those already. I suppose one of the big things, and Colin would have pointed out already, is that the term sheet is not legally binding, but it is a very strong point of discussion. So really, by the time this is going forward as the shareholders agreement, as the legal document, the key things will have been looked at. And I think that whole process really of discussion and of doing of working through the term sheet and the due diligence is really important for building the relationship between the founder and the investor going forward. And I think you basically have to spend a lot of time together. It gives you a good idea of how they're going to work together. So I think that's where the importance of the shareholders agreement comes in for both parties. Sure.
You get a slightly longer look at the companies and the founders as well if you're spending time with them.
Absolutely. Yes, you're meeting with them, you're understanding the product, you're understanding them, you're understanding where they're coming from. And likewise, they're understanding what you're going to be like as an investor. You know, what is this group going to work with? And it's the beginning, I guess, of a longer term relationship. And I think that's quite important for both sides.
Ger, let's come to you. You've got a wealth of experience on boards, serving as exec, non-exec, chairman. Talk to us a little bit about the composition of boards and in particular the role of an independent non-exec chairman.
Okay. The formal role of the chair would probably vary from depending whether you're a PLC or a smaller business, but just looking at the SME, the role really is to set the agenda and to chair the board of director meetings. That's the first thing. The second part of the role is really to set the direction and strategy for the company. And this is something that I think that a little bit of grey in your hair actually helps because it signifies ideally that you built up some experience. And for me, the role of the chair is to provide experience to startups in early stage and even companies that are scaling who may have, the founders may be doing it for the first time. And I think the chairman role is to provide that little bit of experience. So as I said, the formal role is as I've discussed, but the informal one is kind of to provide an advisory role as well, a sounding board. So if the founders have concerns about, say, investors, about shareholders agreements, that you can actually bring a wealth of experience and talk it through with them to allay their concerns and help them to do things correctly. And I'm a great believer in corporate governance and do things correctly from the beginning. And for me, my experience of shareholders agreements have always been good in the sense that, it's the right thing to do. And we can talk about that in further detail in a minute, but I think the role of the chair really is to provide that guidance as well. So that would be a key element to it.
Okay, great. There's a question coming in here. It's probably for you, Colm. The various agreements seem like a lot of burden for startups. They're often very dynamic business conditions. Are there any trends towards making these agreements more flexible, less costly and burdensome for all parties that the panel are seeing? So maybe just a quick, maybe if you kick off on that, Colm. And
am I seeing a trend towards simplifying those type of documents? Well, I think the answer is no, because what in any investment, I always say in respect of an investment agreement that comes in with 30 odd pages of provisions, that everything in there does something and everything in there does it for a reason. And the principal reason is that an investor coming in who's writing a check for a couple €100,000 is going to need those protections, not kind of exercise those protections, but it's the type of thing that they want to have in their pocket to say, look, I'm writing a check here, so I want the protections that it will go right. Am I seeing a trend towards simplification of those documents? No. Do I see a trend towards lower cost associated with working through those documents with founders? Absolutely, I am, yes.
Okay. And Aidan, maybe a question for you in terms of the shareholders agreements in Ireland, UK, Europe, as distinct from the US. Would you have a comment to make there?
The ones in the US typically are smaller, less onerous, and they reflect, I think, the investment community in the US who basically take a kind of a scatter approach when they're doing their investments. They tend to spread them out. So you would normally see documents like, I think there's one now called a SAFE document, which is typically maybe only 5 or 6 pages. But this is normally like a convertible loan that will convert into equity in the future. And then the shareholders agreement would come into place. But they are not as onerous in the US compared to here. It's and the UK. It's a different approach. And I agree with Colm, I cannot see that changing for the foreseeable future. But if a company wants to raise a small amount prior to raising a complete round, we often recommend to them, do a convertible loan note. That convertible loan note normally will be accepted by EI as matching funding. It's a more simplified document. You can do it with, say, for maybe cover you for 6 to 9 months while you continue to do your fundraising. You still then have cash from the convertible loan note to continue your work. So this does help. It does give the investors who come in at the convertible loan note stage a discount to the next round. So it's attractive from many sides. The downside from an investor's point of view is there's no tax relief available to use that vehicle.
Okay, and another question coming through here, and perhaps Aidan, you're best placed to answer this. Do you think EIIS is working for founders?
Oh, I think it is. I think it is been a huge benefit in the last number of years in raising money. The issue with it is the whole administration and burdensome of dealing with the revenue. That is a common problem, whereby it's taken a number of years for the revenue to issue their certificates so that people can claim the tax relief. There are various elements around, how much an individual could claim relief in a year and what types of industries you can go into. So like in the UK, they have, which I think is called EIS rather than EIIS. It is way more flexible, and it offers, I think, up to 50% tax relief for investors. So if we could get it to be more flexible and more investor friendly, I think we could even get more value from it. So overall, yes, it does work for companies, and it is an attractive way of raising money.
Good. Just picking up on Ger's point there about governance, Teresa, what do you like to, what are the processes you put in place, and maybe what do you like to see in a board pack, and that whole area of governance for early stage companies, putting the processes in place and then building on them?
Sure, yes. Eileen, I think it's really important for companies to have good practices in place from the beginning. And I think that can be very challenging for startups because, everything is very busy. So there is a requirement, there are requirements that there is documentation supplied every month. And Aidan spoke about it earlier, the kind of documentation are management accounts, the cash flows, and an update on the latest business plan, and then any key operational issues. It's really good to have those, first of all, for those who are investing to see them, for the board to see the kind of information and to know what's happening. But also for the company, I think it's really good to set this governance up from the beginning to ensure that they have good practices and good management practices. And I think that's one of the key benefits of this. It's really like keeping an eye on the business and ensuring that you're not fully working on the product all the time and losing track of the business. So that's the benefit I see in having a good monthly pack of information.
Right. And Ger, just on running a board, because you've got a lot of experience, as has Aidan, of being chairman of boards, but in the timing of the amount of time allocated to the various elements of the business, so like strategy, future plans, looking back at last month's board, what's your kind of rough breakdown of a good board? How much time you spend on the past, how much time on the future, and what are the other areas?
It depends on the stage of the company. So if you get involved in a startup company, typically there's a lot of time and effort goes into the strategy and direction. And I think I've said this to you before, Eileen, I use the term BHAG, B-H-A-G. So it's a big, hairy, audacious goal. And what it is, it's trying to get the founders to focus on what's the end goal? What are you trying to achieve? What's the realistic timeline? And for me, bringing fun into what you do is a critical part at any stage of a company. But at the beginning, I think it's about getting the strategy, but also getting the governance right, getting the shareholders agreement, because you don't know what the future holds. So if you've got 3 founders and one of the founders leaves after 6 or 9 months and you don't have a shareholders agreement, that founder can just hang on to shares indefinitely for 5-10 years. And it does rankle with the other shareholders that person's gone and they're working flat out to create value. So, and that there's different types of shareholder agreements as well at different stages of companies. So it's not the one document continuously. And I think I come to that later, Eileen. But then if you look at that startup period, it's getting that strategy and direction right. And the board meeting is probably less important in some ways, and you still need to do it, but because you're so involved, I tend to be more involved in the early stages of companies, but if you get involved in a company, Foxborough was a case in point, that would be very, very mature company and had progressed to a couple hundred people when I got involved. That was a different role in the sense that there was very good management structure. So then you're then making sure that the board pack has all the elements that you want to see every month. And again, what goes into a board pack will be determined to some extent as to whether there's investors on board or not. If there's investors, they'll want to see certain things. But if there's no investors on board, and the chairman might be more involved, say part-time chairman might be more involved and knowing what's happening day to day, I would always say that the management meeting, monthly management meeting, would have the operational stuff, and that the board meeting should focus solely on strategy. You know, that you take the operational away. But if you have investors, they want to see a lot of what typically happens at the management level. So the financial pack and so on and so forth. So it very much depends what stage the company is at. And also, secondly, whether there's investors on board at that point or not, as to what you do.
And are you encouraging your companies now to have governance manuals and ESG policies and all those things?
Yeah, and one thing that I would always encourage is a risk register.
Yes.
And a risk register it encompasses everything from external to internal. So internal will be, you know, are we over reliant on one customer? You know, are we, you know, have we any, you know, disaster recovery? You talk about the HSE. What disaster recovery is in place in the event of something catastrophic happening? That the systems are down, data is lost, whatever. The external will be, and internal will be cash flow as well. You know, at what stage, you know, do we need a buffer in terms of funding? It's a whole load of factors. The external factors will be if you head into, you know, economic downturn, how are you fixed, and what can you do? So it's having an awful lot of, it's capturing all the risks that might be attaching to a company. So I would always recommend a risk register in terms of capturing that. And good corporate governance will encompass that.
Oh, that's really relevant, and I think it's something that's not, you wouldn't find it in every early stage company, that's for sure. Yeah. A question for you, Aidan, from Joe Burke. Hi, Joe. And it's about, do early stage investments, for example, like the CSF, cause complications with later investments?
No, I don't think it does. You know, CSF is limited to EI's involvement, which is what 10% initially when they invest. But even if and there's a further round in EI come in with as a HPSU, that 10% does not get breached. So we would see it as part of the bootstrapping. It helps the company to get through the initial stages. So yes, I would see it as a benefit. I wouldn't see it as a hindrance.
Okay. Teresa, maybe you'd take this one. What level of IP protection are investors looking for before making their investment?
On IP, I'd say it depends. It depends a lot on the business. There are some businesses where the IP is really important. In other words, that we can see that there will be patent protection on the technology. And particularly technical companies, generally when companies are coming for investment, there's a certain level of IP, either the application is there or it's going through the process. So that will be very important. There are quite a few though where the IP just really isn't that relevant. IP won't be applicable to that company, or if it is there, it won't really mean anything at the end of the day. But in some of those companies, what's more important is the product itself, the idea, or the people who are involved. And this may be a business that won't have IP, but it may be something that a larger company would be interested in the future, maybe an important business. So quite a few companies don't actually have IP, some do. It depends an awful lot on the actual business.
Okay, great. Thanks, Teresa. Colm, do you have any war stories of where things went really, people landed themselves in the Shize because they had really not done things right from the start?
Yeah, do I have war stories? Well, look, when they're talking to the solicitors, it's usually going to involve a war story at some stage. And the one that raises its head most typically is perhaps outside of that initial kind of bracket of shareholders agreements that I spoke about, which are tied to an investment for shares or subscription for shares, but more a case where you've had a company that perhaps hasn't raised external finance and they've just grown organically, and you might have 2 or 3 founders in there, and one of them wants to put their shares into their husband or wife's name, or one of them wants to make sure, perhaps because of how they view their commitment to the job, want to transfer the shares to someone else. And that's typically the one that causes a jar in that type of scenario, because the shareholders, the founders, haven't sat down and agreed between themselves, well, look, I'm okay with you transferring your shares into a holding company as long as it's wholly owned by you, or I'm okay with you transferring your shares to your husband because I like the guy, or, you know, on the flip side, no, I'm absolutely not all right with if you pass away with your shares going into your family. In that type of instance, I'd want a compulsory transfer event to make sure that the shares are put back into the company or offered to the other founders for value, to make sure that the estate gets the value, for example. So that's the usual ding dong, and you get that less so in that first type of shareholders agreement where someone's raised funds and investors require those rules around share transfers to be put in place. That tends to be addressed, but that issue kind of raises its head as to the ownership of the shares, because it's prompted a lot by, well, look, the business is worth something now, these shares are worth something, so people will start after time thinking about where they want those shares to go, you know.
I'd say you have lots more stories you could tell us. I'm just conscious of time, but a question coming in from Rena Maycock, probably for you, Aidan. If a board of directors decides founder or promoter should be replaced with a new CEO, CTO, for instance, to progress the business to the next stage, does that constitute a good lever and therefore trigger reverse vesting?
More than likely, it would constitute a good lever, yes. If there's an agreement amongst all parties, more than likely. If there is a reason why they got rid of him because of some issues, then that may cause a bad lever to arise. My experience is that most companies settle these things, and that the individuals do become a good lever. Then the issue is all around the value of the shares, and that is normally the big issue. And if they put it out, then it goes to an independent auditor for valuation purposes, which takes a long time and probably will not give the promoter the value that they believe that they're worth.
Thanks, Aidan. There's a lot of questions. We're not going to get to them, but maybe, Larry, if there's one burning one that you see in there that we could take fairly easily, we'll do that. I want to come back, Ger, to the whole idea of the shareholders agreement being a live document and that it changes over time. So I think that's an interesting one. A lot of people see this as a document that's put in place from day one, never changes, and you're stuck with it. But maybe you just tell us a little bit about what, how you see it evolving and the places where it may change.
Yeah. Okay, and this timing of that question is very good, because I'm looking at a question from Michael Morrissey here, where he says the various agreements seem like a lot of burden for startups and so on. But you can't do a very simple shareholders agreement at the startup of a business. And for me, in a startup, it's next to impossible to put a valuation, because you're creating the business, and it normally takes a number of years to create a business. So the startup shareholders agreement for me normally centers around if one or two, the 2 or 3 founders, if one of them leaves, what happens to their shares? If one of them, decides that they want to step in competition to the startup, for me, that's a bad leaver. You need to have a bad leaver definition in it to protect the business. So for me, there is a need to have a shareholders agreement at the beginning of the business, but keep it simple. It doesn't have to be a complicated document. You could crack it out in a couple of days, put your mind to it, really. And for me, that's where a chairman probably, or some non-exec comes in that they can kind of be independent and guide the discussion. So it's not 1 or 2 or 3 of the founders going at it together in a room and probably creating a little bit of tension at the beginning of the journey. So you want to avoid that. Rolling forward 4 or 5 years, the company is up and trading, it's doing really well, whether it has IP or not IP, you can actually benchmark the valuation of it either through EBITDA and a multiple of EBITDA for the sector that's operating in, which can give you a valuation, or through, if it's got IP and recurring revenue, and maybe not as much EBITDA, but you can actually benchmark against other companies in that sector, and you can put a valuation clause within the shareholders agreement. And for me, that should be a separate shareholders agreement from the one that was put in place at the beginning, because now you're in a situation that your valuation clause in your shareholders agreement will be totally different to what was there at the beginning. So for me, shareholders agreements, it's not as if you put one together and it's there forever. And the third point I would make is that when investors come in, they typically want to amend the shareholders agreement. And Aidan will give loads of examples of that, I'm sure. But typically the one that you have in place, they'll come in and say, well, actually, we're happy with 80% of it, but there's these various clauses we want to change. One of those would be around the majority shareholding having to give approval for certain transactions, such as issue dividends, issue new shares. There's normally a list, it can be 20 or 30 items that the board or the management can't do, raise significant finance and so on. So for me, there can be possibly 3 different shareholders agreements over the course of 5 or 10 years for each of the different stages that the company's at.
Very, very interesting. There's so much more. I mean, I'm just looking at the questions and there are just so many of them, and so much more we could cover. But we've just scraped the top of this, and I think we'll have to come back to it again. I mean, there are whole sorts of things like dilution that Aidan touched on, but we didn't go into in huge detail, and it's an area a lot of people don't understand. So we've got a poll here, which we're going to run to just ask people what they'd like to see more of: board size, composition, classes of shares, warranties, restricted covenants, reverse vesting, cap table, understanding dilution. I mean, it really is a very very complex area. I thank you to everybody who put in some questions. We'll find some way of getting some responses to you. But before we finish, I would like to just give something to our audience to take away from this. And I would like to ask each of the panelists, what is the one thing, if you had to crystallize what is really what you see as being critical for companies to address and understand and take away, what would that be? Maybe we'll go to you, Aidan.
I hope I won't be taking Teresa's input here, but to me, the term sheet is the most important thing. Having that in place, having that issued very early to the promoters, I think solves a lot of issues going forward, clears up problems that could arise in the future, and it would definitely speeds up the whole legal process as well.
Great. Colm.
Yeah, I think I mentioned it earlier, Eileen. It was take that opportunity to use what can be ostensibly a defensive kind of warranties exercise, where you might put the guard up and become a little bit closed, kind of flip that around into an opportunity to make it a collaborative exercise. And if there is a problem in the business, be open about it, be transparent about it. If it is an employee issue, for example, pick the brain of your investor. Look, I have this employee here, they're being difficult, what do I do? Or I had this customer here, they're a significant customer, you know, that they put a complaint in there, how do I handle it? You'll get real added value out of the investor from that perspective, and it'll put the benchmark down as to whether this person, the investor and the founders, can actually work together in good times and when problems arise, as they invariably will. So use that disclosure exercise positively.
Great, thank you for that. Teresa.
Well, bringing together all of that, I would say the shareholders agreement is beneficial for everyone. It gives a strong legal basis to the relationship between the founder and the investor. And really all the discussions that take place enables them to build a strong relationship. So in that sense, I think it can be seen as something very positive for both parties.
Great, good note to end on there, Teresa. And Ger?
I think look at shareholders agreements and governance and doing things properly from day one as a positive, because there's a fear with a lot of companies who probably aren't familiar with these and look at themselves, geez, legal agreements and governance, but really start as you mean to go on. And for me, it's all positive. The outcomes are all positive, and you're enhancing your chance of a good outcome down the road by having these in place. And on a final note, never forget it's the journey that counts, and have fun on the journey.
Fantastic. That's a great way to finish. Just on the poll, by far and away, the most requested topic is the cap table and understanding dilution. I think you scared everybody, Aidan, when you put up those slides. They were saying, oh my God, this is stuff we don't know about. So we're not surprised at that, actually. Just want to say thank you so much. I really enjoyed it, and I hope our audience have as well. Thank you, Aidan. Thank you, Colm. Thank you, Teresa, and thank you, Ger. It's been great, really, really useful, and I think we're going to have to do a lot more of it. So thank you all for that.